I'm Don Fry, President and CEO of the Greater Baltimore Committee, and welcome to this morning's program, a conversation with U.S. Treasury Secretary Tim Geithner. The response to today's breakfast was overwhelming. Within only a few days announcing this very special program, we're forced to turn people away due to space limitations. I appreciate all your support and your enthusiasm for this event. First, you'll hear comments from Secretary Geithner. Following his remarks, Jeff Salkin of Maryland Public Television will sit down with the Secretary to ask some questions that he has prepared, as well as questions that you sent to us in advance that you'd like to hear the Secretary answer. Before we hear from the Secretary, let me introduce some of the very special guests that we have with us today. First, the Mayor of the City of Baltimore, Steffi Rawlings-Blake. Governor O'Malley could not join us today, but we're pleased to be joined by his Chief of Staff, Matt Gallagher. Also joining us from the Treasury Department is Undersecretary for Domestic Finance, Mary Miller. Just this past Tuesday, we had our annual meeting where we announced our new Chairman of the Board, and it's Brian Rogers, Chairman and Chief Investment Officer of T. Rowe Price, and also the new Chair of the GBC Board. And Charlie Monk, former Chairman of the GBC Board as of Tuesday. He's the happiest man in the room right now, from Saul Ewing. We're also joined by many other members of the GBC Board of Directors, and we thank them for their support. We're honored to have the 75th Secretary of the United States Department of Treasury with us here today. Having served as Secretary of the Treasury since January of 2009, and previously as President and CEO of the New York Federal Reserve from 2003 to 2009, Secretary Tim Geithner has led the response to the global economic crisis, the design of the ongoing recovery, and has guided the formulation of new rules and regulations to limit the risk of future crisis. Ladies and gentlemen, it's my pleasure to present to you Secretary Tim Geithner.
Thanks, Don. Nice to see you all here. Thanks for coming out. Hope you had a good breakfast. If you look carefully at the mayor over there, she's got a nice plate of bacon and 2 big cups of coffee. But I admire what she's doing for the city, and again, it's nice to see you all here. Mary Miller, Don introduced to. Mary Miller is Undersecretary of the Treasury for Domestic Finance. She's got one of the coolest, hardest, most consequential financial jobs in the world. She's from Baltimore. So I want to talk to you today about the American economy, about its strengths, our challenges, and the important economic decisions we face as a nation. I'll talk a little bit about what's behind us, what's ahead of us, and I'll try to explain what we're for and what we're against. How is the U.S. economy doing today? The economy is gradually getting stronger, and we've come a long way since the fall of 2008. But I think, as all of you recognize, we have a ways to go to repair the damage caused by the crisis, and we still face some very tough challenges, including many that preceded the financial crisis itself. Our economy, the American economy, has expanded at an average annual rate of about 2.5% since the summer of 2009. We've grown about 7% in total since that period when growth began. The private sector has added more than 4.2 million jobs since job growth resumed, including almost 500,000 jobs in manufacturing. Strongest job growth in manufacturing since the mid-90s. And growth has been led by the private sector, by private investment and exports. The balance sheet of American businesses are very strong, and the economy as a whole and the average American worker are more productive, significantly more productive than before the crisis. Investment in equipment and software has risen by 34% over the past 2.5 years. Exports have grown 26% in real terms over the same period. And growth in investment and exports has far outpaced the average for comparable periods after the last 8 recessions. Growth in the American economy has been relatively broad-based, with increases in manufacturing, in energy, in agriculture and high tech, offsetting the continued weakness we still see in housing and construction and the significant ongoing contraction in the overall size of government and government services and employment. American companies are starting to move production back to the United States after decades of offshoring. And we're making significant progress. Thank you, Stephanie. We're making significant progress. No, I'll pause on this to show a little optimism about this. You know, when big global American manufacturing companies are moving the production of things like appliances back from China and Mexico to the United States, good things are happening in the American economy. We're making significant progress working through the excesses and the imbalances that helped cause the financial crisis. Household debt is down almost 20 percentage points relative to income, roughly back to 2004 levels. Financial sector leverage is down substantially, and credit is expanding. Housing and commercial real estate construction are starting to pick up after 5 years of contraction. Americans are saving more than they did before the crisis, and our fiscal deficits have started to decline as a share of the economy. We're borrowing now much less from the rest of the world relative to GDP. Our current account deficit, which is the measure of how much we borrow from the rest of the world, is now half the level it was before the crisis. Now, these are encouraging improvements in the American economy, and they're the direct result of the broad strategy of the crisis that the President put in place in those dark days of early '09. Now, if you just think back to that period of time, you know, the American economy is contracting at an annual rate of about 9% a year. We were losing 750,000 jobs a month. And the President did not sit there and hope the fire would burn itself out. He didn't commission a bunch of studies. He didn't try to do the politically careful thing. He did the hard, tough things early, enormously difficult political things, and we're much stronger today as a result of those choices. And he put in motion a series of other crucial changes for the American economy. Millions of Americans now have health care with better coverage because of the Affordable Care Act, and health care costs are rising more slowly. We're becoming more efficient in how we use energy, drawing more on clean energy resources and less dependent on foreign sources of energy. And in communities across the country, we're seeing promising reforms in education to improve the quality of teaching in science and math and reduce the cost of and improve access to higher education. Now, we have a lot of work to do to repair the damage caused by the crisis and to get more Americans back to work. And we still face a lot of risks ahead. We still live in a dangerous and uncertain world, with Europe confronting a severe and protracted crisis. We're engaged in a critically important struggle with Iran, which added to upward pressure on oil prices earlier this year. And of course, at the end of this year, we face the simultaneous expiration of tax cuts and a large across-the-board cut in spending. And this presents a risk, but it also provides an opportunity for bipartisan agreement on reforms to restore fiscal sustainability. Now, the acute damage caused by the financial crisis hit an economy that was already suffering from a slow-burning mix of formidable long-term challenges. These challenges include the failure of our education system to keep up with the rest of the world, a long period of stagnation in the average and the real median income, diminished confidence in the ability of Americans to exceed the economic achievements of their parents, a substantial ongoing shift in the risk and cost of health care and retirement security away from employers to individuals, the significant erosion in our national fiscal position over the last decade, and poverty rates that are much higher than any country around the world with comparable wealth. And confronting these broad challenges is the most important economic policy challenge facing the nation. You know, we can all be in favor of smarter regulation, of more efficient government, lower future deficits, and a more simple tax system. But these aspirations, they don't add up to a strategy that meets the scale of the challenges we face today economically. They don't amount to a plan for a stronger, more competitive economy with broad-based gains in income. A credible strategy for economic growth, which is the central challenge we still face, requires a willingness and an ability to do things, not just to cut things. Now, our strategy, the President's economic strategy, combines actions to help speed the pace of economic growth in the short term with reforms and investments to lay the foundation for stronger future economic growth. And as we focus on the future, it's important to still recognize that to better position to deal with those challenges, we have to strengthen growth now. And the most effective way to get more Americans back to work is to strengthen economic growth today. Now, Congress acted this week to reauthorize the Export-Import Bank, which helps American businesses export their products around the world, but they have more work to do. Congress needs to act to prevent interest rates on student loans from doubling this summer. They should act to pass a transportation bill so we can put more resources into rebuilding America's infrastructure. And the President has proposed 5 additional steps Congress can take right now to help expand economic growth, helping Americans refinance their mortgages, creating incentives for companies to bring back jobs from overseas, putting veterans back to work, creating jobs by investing in clean energy, and cutting taxes for small businesses. Now, since the President took office, he's signed into law 18 specific different tax cuts that directly help small businesses and he's helped support billions and billions of dollars of additional lending to small businesses. The proposal we're asking Congress to consider now would give a 10% income tax credit to companies that increase wages or employment in 2012, and we also propose to extend 100% expensing through 2012 for all businesses. Now, of course, alongside these immediate steps to help the economy now, we have to continue to work to put in place a stronger foundation for growth looking forward, and this requires investments in education to help Americans compete in the global economy, investments in innovation so that we can stay on the leading edge of technology and help create the best jobs possible, investments in infrastructure to help also reduce business costs, improve product productivity, and it requires reforms to improve the incentives for investment in the United States, including reform of our business tax system. Now, these investments and reforms have to come as part of a carefully designed balanced package of long-term fiscal reforms to help restore fiscal sustainability. Now, like the Bowles-Simpson report and like all the other bipartisan deficit reduction plans out there, our approach, the President's approach, combines spending savings across the government, across all the programs of government, with tax reforms that would raise a modest amount of additional revenue. Now, these broader fiscal reforms would be phased in over time to help protect economic growth and give Americans time to adjust to the changes ahead. They would cut roughly $2.50 in spending for every dollar in revenue raised. And the spending savings in our approach, our proposals, would build on the cuts put in place last summer with reforms to programs like farm subsidies and changes to make Medicare and Medicaid more financially sustainable. And these tax increases would fall only on the top 2% of individual earners. And they would be combined with tax reforms to our business tax system that would lower the corporate rate and eliminate inefficient tax preferences for businesses, helping to improve long-term incentives for investment in research and development in the American economy. Now, in our proposal, most of the savings from spending cuts and revenues from tax reform would go to reduce our long-term deficits to the levels necessary to start to reduce the overall debt burden as a share of the economy. But the President believes it's essential that as we reduce these long-term deficits, we have to create some room to expand investments in key areas that are important to future economic growth, like education and infrastructure and innovation. Overall, by combining tax reforms with spending savings, the President's plan will reduce deficits without cutting too deeply into the safety net for low-income Americans, without undermining our national defense or our ability to improve education or our commitment to health care and retirement security for our retirees. Now, any sound fiscal plan, any sound plan to restore fiscal sustainability has to meet 3 basic tests. Is it phased in gradually over time so it doesn't undermine economic recovery? Does it balance spending savings with modest revenue increases so that the middle class and retirees don't bear too much of the burden of the adjustments to come, and so that we can preserve some room for investments that are important for future economic growth. And finally, does it protect the long-standing bipartisan commitment to health care and retirement security for the millions of Americans that retire in the coming decade? Now remember, the basic math of fiscal and economic policy is not political. There's no particular Democratic or Republican fiscal math. If you try to restore fiscal balance without a penny of additional revenue, then you have to cut deeply, too deeply in our view, into critical functions of government. I'll just give you one example. The cost of extending the Bush tax cuts for the top 2% of American taxpayers for the next decade is about $1 trillion. Tax cuts, as we've learned, don't pay for themselves. You have to pay for them. We can't afford to borrow the money to extend those tax cuts. And we're not going to agree to cut benefits for seniors or cut deeply into investments in education in order to pay for those tax cuts. Now, we face some very tough challenges ahead still, but these are manageable challenges for the United States. And I would prefer, and I still prefer, our challenges to those of any country in any economy around the world. The challenges we face today, these economic challenges, an economy still healing from the financial crisis, Europe caught in a very difficult, very damaging economic crisis, the remaining threats to our national security, the competitive challenges we face from other nations, these challenges can only be met with an economic agenda that focuses on strengthening economic growth, on investing in education and innovation so that we're expanding opportunity for Americans, and with a balanced approach to long-term fiscal reform. These economic challenges cannot be solved. These economic challenges cannot be solved by an agenda that promises severe, immediate austerity, combined with deep, permanent cuts in education and the safety net for retirees, caps on spending programs that could not plausibly accommodate the 25 million Americans that become eligible for Medicare and Social Security over the next 15 years, opposition to financial reforms that are essential to protect the economy from future mistakes in the financial system, irresponsible promises to all Americans that we can reduce their taxes, and serial threats to default on the nation's credit. As you can tell, I'm not very enthusiastic about that strategy for the country. Now, we've successfully navigated the most dangerous phase of the worst economic crisis in generations. We have to bring the same creativity and force, the same sense of pragmatism, the same sense of national purpose to these remaining economic challenges ahead. And that's going to require better choices from our political system. It's going to require recognition of these basic economic realities. And no economy can be stronger over time than the ability of its political leaders to come together and make some tough decisions. Thank you. Nice to see you. I'll be happy to have a broader conversation about the questions you submitted.
But I should start with some news questions. What's your impression at the moment of what's happening in Greece, and to what extent is our economy at risk if there's a default or a withdrawal from the euro?
Well, as you all know, and you've been reading for the last 2.5 years, Europe's, still caught in the grip of a very tough financial crisis. And that crisis, as it's evolved, has been quite damaging to growth around the world, even just over the last 2 years or so. And it still poses some risk to the American economy. They are trying to put in place a more credible strategy for managing this crisis, for trying to make sure that the monetary union can work. And as you can tell, they still have some work to do to try to contain the risk of a broader crisis. What you're seeing now is, in addition to the efforts to try to find a path forward in Greece, and the Chancellor of Germany yesterday made some very important comments on this. She said that it's important to Europe and to Germany to keep Greece in the euro, and that Germany plans to show some more flexibility in how to make that possible for them. But what they're also talking about is trying to figure out a better balance between growth and austerity. ways to mobilize more public investment in infrastructure and target that to the weakest economies in the region. They're working to make sure their financial system is strong enough to weather the storm. They're putting in place what they call a fiscal compact. It's not quite what Hamilton did in the United States 2 centuries ago, but it's a way to try to make sure that they have a more integrated, coordinated capacity to run fiscal policy across a continent with very different economies. So they're trying to work through those problems, and it's you can see it's a challenge for them. But they have the capacity to manage this, and our of course advice to them, which we provide with humility and bearing the scars of our crisis, and the choice we made here is to try to manage this in a way that's going to cause less damage to our economy and the economies of the rest of the world.
What do you know about the banks in Greece? To what extent are they under strain at the moment, and have they been able to get the help that they need from European authorities? If that needs to go further, in terms of potential United States involvement, what would be on the table, what would be off the table?
Across Europe, there's a very important effort underway to put more capital into the financial system, not just in Greece. As you know, that's one of the most important things you do in a financial crisis. It's important not just to make sure you preserve some stability in the financial system, but so that the financial system can provide the credit you need to grow. And what we did in the United States, as you may recall, is we forced the largest American banks, over their significant objection, frankly, to go out and raise $300 billion of common equity at a time where the system was very fragile. And in addition to that act and the other reforms we put in place, we moved very quickly to make sure our financial system was going to be strong enough, not just to protect the savings of Americans, but so they could be able to finance a growing recovery rather than to impede an expanding economy. So what Europe is doing, and they have more work to do in this, is try to, and they've come to this judgment a little too slowly, is to try to make sure there's enough capital in the financial system that they have the kind of guarantees of funding that you need for financial systems to survive financial stress. And that's important even as they go ahead and think about ways to get economic growth going more broadly.
To the extent the IMF becomes involved in something down the road, a larger U.S. contribution, would that be on the table?
No. Europe is a very rich continent. They have the resources to deal with this. The IMF already has a very substantial pool of resources available. It's playing a very active role already. And of course, we participate indirectly through the IMF in this case. But we're doing what only the United States can do, and we can uniquely do. And we did this in 2008, in 2009, and we're doing it now, which is the Federal Reserve is making available dollar liquidity to the central banks of Europe so that they have access, their banks have access to those dollars and are less, therefore, in need to delever and shrink their balance sheets in the face of economic recession. Only we can do that. We're doing that, and that's a very necessary, helpful contribution to their efforts.
Let me ask about J.P. Morgan for a moment, and then we can get to the GBC questions. There was a New York Times report that exiting these transactions hasn't gone well, and that the loss could be heading towards $3 billion as opposed to $2 billion. There was also a report yesterday of a preliminary FBI investigation. From what you know about this case, is a criminal investigation warranted here?
Well, as you know, I can't speak to that, but I can say the following. This is obviously a material, significant failure of risk management, and it makes a very powerful, compelling case for the financial reforms we've already put in place and the ones we're still in the process of shaping. And the Federal Reserve and the SEC and the other regulators who have responsibility for these rules are going to take a very careful look at what actually happened and try to make sure that these rules are tough enough and effective enough so they meet the critical test. And what's the critical test of reforms? The critical test is not whether you can prevent banks from making mistakes or from occasionally losing money. That's inherent in their business. The test of reform is whether the safeguards we put in place in the system prevent those inevitable mistakes from causing broader damage to the economy, to other financial institutions, and to the taxpayer. And I am very confident that we're going to have the ability to make sure that not just the reforms we've already have in place, but the reforms that are still taking shape are going to meet that test. They're going to be tough enough and effective enough to do that.
All right, let's get to some of these questions. We continue to overspend and increase debt. What is going to stop us from becoming the next Greece in a couple of years?
Actually, that's a common perception, but it's a deeply misguided perception about the basic trajectory of the government of the United States and what's actually happening. So let me explain why that's true. The only part, the government deficit is declining now as a share of the economy. Jobs and employment and services across the governments of the country are falling, not rising. The only part of what people think of the government that's growing going forward now is Medicare, Medicaid, and Social Security. And those cost increases are being driven by the fact that more Americans are retiring. They're driven by demography. You can't repeal the aging of the population. And they're driven by the fact that health care is expensive. And although the costs are rising more slowly than they were in the past, they're still rising, as you know. So the common perception out there that the government is on a path to inexorable expansion that's going to lead us to weeks in the future is not true. The truth is that the deficit is falling as a share of the economy. And of course, we're going to have to put reforms in place, as I said, take other actions to make sure the deficits fall to a level where our debt stops rising as a share of the economy. But those changes are not beyond our capacity as a country to do. They require pretty modest changes in spending and revenues to get there. I'll just give you an example, just in terms of the magnitude of this, because many of you are businessmen and women. The debate we're having about the shape of long-term fiscal reforms is about how to find additional deficit reduction of about 2% of GDP. 2% of GDP. Not 5%, not 10%, 2% of GDP. And we're proposing to split that remaining set of deficit reduction stuff roughly 50-50 between spending cuts across the government and revenues. And the reason I say that, because with those reforms, and this is important to point out because a lot of people think this is beyond our capacity, it's just not true. These are pretty modest changes can achieve this. If you are able to legislate those reforms along the lines of what we proposed, or it's Bowles-Simpson or the other bipartisan commissions, then you'll reduce the deficits over the next 5 years or so to a level where the debt stops growing as a share of the economy and starts to come down. So there is a powerful myth today in the American political debate, not a particularly noble debate, that suggests that the weakness in the American economy today is the result of too much spending and too much growth in government. And there is no basis and no credible argument in support of that.
What happens to economic growth if we do that? If we increase revenues and we cut spending over some period of time, we have this very modest 2%, 2.5% growth rate. With all this stimulus on the fiscal side, the monetary side. We're talking about reducing the fiscal stimulus. What happens to growth?
Well, it's a good question. That's why you want to do this carefully. I mean, you can look around the world and see a great natural experiment and what happens when you do this poorly with too much severe austerity too quickly, or in ways that undermine your capacity to grow in the future. So that's why we put so much emphasis on the need for balance in the design of the reform plans. And balance, what does balance mean to us? What balance means to us is you want to put the deficit on a glide path to sustainability.
How long is the glide path?
Can't do it all from. It should be 3 to 5 years, not 1 year or 2 years.
Not 10 years.
But definitely not 10 years. And you have to do it in a way that locks the Congress in to live within those constraints and live within those means. That's one test of balance. Second test of balance is you need to make sure that you have a balance across the spending cuts and the revenue side. Just for the basic reality, put aside the arguments about fairness, which are pretty powerful arguments for an economy with unemployment where it is today and poverty where it is today. And remember, 40% of Americans today are born to families on Medicaid. So put aside the arguments for fairness, with overwhelming compelling arguments, and just look at the basic fiscal math of this. If you try to restore even that modest amount of fiscal discipline across the economy and do it without revenues, then you have to go find between $1 and $2 trillion of additional savings. Where are you going to find that? You have to go to defense, education, Medicare. So I do not understand how people believe that you can offer the American people a credible argument of how they're going to make sure that their kids have a chance to go to better schools or afford education, or how we're going to have more investment in the country with an infrastructure in this state, unless you have that balance. That's another one. Second test of balance is that, and the third test of balance is, you have to think about how best we protect the safety net for retirees. The safety net in America today is not a very generous safety net. Just ask people to remind you what the average Social Security benefit is today, or what the average Medicare benefit is today. We still live Americans with an overwhelmingly large share of the costs on their own for paying for health care and for retirement security. So when you think about the balance, the structure of these things, just remember that basic reality too. So you're right, if you do this in a way that's poorly designed, you can do a lot of damage to economic growth. And again, just look around the world today. If you wonder if that's true, look around the world today, that question. So you should do it in a way that phases it in gradually and is carefully calibrated. And the tax reforms we're proposing in our basic framework would apply to only 2% of American taxpayers. And even those changes result in only a modest increase, would result in only a modest increase in the effective tax rate on those top 2% of taxpayers. The economy can handle that, can withstand it, but you just got to do it with a fair amount of care and balance.
I also wanted to ask about the debt ceiling. I read somewhere that we're going to hit the current debt ceiling as soon as September. And obviously there's some extraordinary measures that you have at your disposal. When does this next crisis hit?
Well, it's not a crisis. Does not need to be a crisis. It's a crisis of Congress's making. No country in the world. Remember, Congress is the only authority under the Constitution that can determine how much we borrow and spend, how much we tax and spend. They have the sole responsibility for that. And there's no need for there ever to be a crisis around this. And the country's had, decades and decades of experience managing through this by Republican presidents and Democratic presidents without the amount of drama and pain that the Republican leadership caused the country last August. Under the current estimates, and these estimates depend on how the economy performs going forward, the market believes, and I think our people confirm, that we're likely to hit the debt limit sometime towards the end of the year. Not as early as you said, but towards the end of the year. But then Congress has given administrations a set of tools they can use to allow Congress to take a little more time. And those tools will take us somewhere into, our current estimates, 2013. So Congress is going to have to act to pass this again. Our view is, do it in a way that's not going to cause the kind of pain and damage that caused the economy last summer. Just an example, you probably remember last summer, but the fall in business and consumer confidence caused just by the threat of defaults hanging over the country at that period were as large as what happens in a typical recession. And there's just no need and there's just no reason, and it's not responsible to put at risk people's confidence in the credit of the United States. There's no credible argument for that. Now, some people argue that you need that as an inducement to force the politicians in Washington to do some tough things on fiscal discipline. But remember, there's a huge mix of expiring tax cuts and very substantial automatic cuts to spending that go in place at the end of next year if Congress doesn't act. That's a pretty powerful incentive. That's a really powerful incentive for Congress to come together and start to put the fiscal deficits on a glide path to sustainability. You don't need to put the threat of default over the country to try to induce politicians to act on that front.
Let's take another GBC question. We now know that the UK is in a recession, the Eurozone is in a recession. Are we now looking at the prospect of another springtime disappointment after positive economic signs like we experienced in 2010 and 2011?
It's good to go back and remember that history because, we live in a global economy and we're very affected by what happens around the world. And one reason why growth slowed in 2010 and 11 was because of the European financial crisis. And then in 11 we had the Japanese crisis and the oil shock then. So yeah, absolutely, we still live in an uncertain world, and those risks out there are challenges to growth in the United States, and that's why it's important for Congress to do what it can still to try to make sure we're doing things to get the growth stronger now. That's good insurance and good protection against that. But the economy, I think by really almost any measure, is stronger now than it was then, and the growth is more broad-based and it's more resilient, and confidence is higher, and the financial system's in a much stronger place to manage those stresses. But you're right to remind people that there's still a source of risk, and if growth slows going forward now from these levels, it's likely to be because of this mix of risk, and they are the European crisis, the inability of Congress to pass sensible things that would make growth stronger, and this looming concern that this set of expiring tax cuts and spending increases are not going to be handled in a careful, responsible way.
What are your thoughts on using contingent capital securities, i.e. bonds that would become common equity should a bank fall below certain minimum equity requirements, as a means of reducing the need for taxpayers to get involved when systemically important firms become troubled?
It's an interesting idea. It's got a lot of support among some central banks and supervisors around the world. I think our basic view is the best strategy, again, to protect an economy from the mistakes banks made is make sure that they hold much more capital against risk in the form of common equity in particular, that they fund themselves more conservatively so they're less vulnerable to funding pressure, that they take less risk, less leverage, and that they understand that if they manage themselves to the edge of failure, that we're not going to protect them from those mistakes. And what we'll do is step in and dismember them in a way that's safe for the broader system and the American economy as a whole. And that's what these broader financial reforms we've put in place will do. But there's a lot of interest in variants of that idea as part of resolution strategy.
Interest rates are at historic lows, but more than 25% of the Baltimore metro area is burdened with negative equity in their homes, including in most cases a second mortgage or equity line. Given those long-term realities, even fewer people are choosing home ownership, so housing values are continuing to decline. How much of the national debt, or I suppose how much of the national economy is wrapped up in the housing crisis?
Well, housing is still very tough. And you're right that there are still hundreds and hundreds of thousands of people across the country today that are still at risk of foreclosure, face foreclosure. And our view is the most important things you can do about that are first, to make sure more people have a job, that growth is stronger. That is overwhelmingly the most powerful determinant of how fast we repair the remaining damage in the housing market. Second, that Americans, including those underwater, have the ability to refinance and take advantage of lower interest rates. That's a very powerful tax cut type effect, gives more income to people. That's helpful to avoid the risk of default as well. To make sure that for Americans that can afford to stay in their homes, if they get a modification in their mortgage, that they get the opportunity to get that. So we have a range of programs in place to help people restructure their mortgage obligations in a variety of forms, or if they need to, through a short sale, to leave their house. And then finally, we're trying to get a larger share of the homes that exist in the inventory of the GSEs and the banks now into the rental market more actively. Those things we think would be helpful in trying to speed the pace of repair in the housing market and minimize the remaining risk there. But remember, overwhelmingly the most important thing that happens is you want to make sure more Americans have a job and that income gains are rising. And that requires a lot of care from Washington in avoiding let's say carelessly designed fiscal policy going forward.
On the GSEs, in general, what is the Treasury plan for Fannie and Freddie? Will they be retained, possibly floated as conduits or financial intermediaries without a portfolio of assets? Will the agency portfolios be allowed to run down?
Well, we are trying to lay out a broader path to wind down those enterprises and to pull private capital back into the mortgage market so that private capital, once again, is the dominant source of mortgage finance. And we are consulting very closely with members of Congress and with the broader housing, financial, real estate communities on what mix of long-term foundations we want to see in a future housing finance system. But our focus now, just to be direct about it, our focus right now is where it should be, which is on doing things that will help speed the pace of recovery and repair in the housing market and help create the conditions where private capital can come back in. That should be the dominant focus of our efforts, and we're going to keep focused on that even as we consult with Congress on those long-term reforms.
When does the country get its AAA credit rating back from S&P?
I'd say it depends on what Congress does. Again, if you look at how the world thinks about the United States today, you can see in markets a pretty good test every day of the basic credibility of the United States. And if you look at those measures of fear of default or fear of future inflation, the world is very confident in the ability of the American political system to manage these fiscal problems. They may be more confident than Americans feel. But that's confidence we have to earn over time. You can't depend on it. You have to earn it. And that means that Congress has to figure out a way to come together and reach agreement on another substantial contribution to long-term fiscal responsibility, and to do it in a way unlike last August, where they caused a pretty catastrophic loss of confidence in the American political system. So world's pretty confident in the ability of the United States to always do the right thing ultimately, but we got to earn that confidence and demonstrate we have a political system that can do that.
Why do you think companies have been slow to hire? We've seen a nice earnings reporting season, balance sheets are good. Is it this combination of automation and outsourcing, or is there something else going on, and is there a way that policy can be helpful?
Well, first, as I try to explain, if you look at actually the pace of job growth and you look at the pace of private investment in equipment and software, it's actually been pretty strong relative to past recoveries. I know there's a perception that it's anomalously slow, but that's actually not quite true. And businesses as a whole across the economy are acting with progressively greater confidence in the strength of growth they're going to be able to meet around the world in the United States. But what's it going to take to see more of that confidence? And I think that, remember the shock of the crisis in 2008 and 2009 was really overwhelming. I mean, the level of panic you saw across not just the financial system, but across the American business community was incredibly strong, and people were not sure when we were going to come out of this, how we were going to come out of it, and that had long-lasting effects on caution. It made everybody much more tentative, much slower to come back, and much more, frankly, traumatized by each new stage of concern you saw, like from Europe, or even from the oil shock, or from Japan. That made people tentative too. So I think most of what you see around the American economy today is still the aftershocks and the legacy and the scars of the crisis. And remember, when you come out of a financial crisis, because you have to bring down debt, and you have to reduce leverage, and you have to work through a huge overinvestment in real estate. Those things are things you have to do, and they make growth slower than it would otherwise be. But the more you get that behind you, the stronger you're going to be going forward. And so there's a sort of paradox in that, which is that it makes growth more moderate than you'd like in the early stage of recovery from a financial crisis, but it's a sign of health and repair. So again, I think you're seeing a gradual, steady improvement in confidence, but people are still aware, of course, that of the risks we see outside the United States, and still concerned, frankly, about whether Washington is going to act responsibly over the course of the next 6 months.
9:15. I think I'm supposed to wrap it up around now, but I've one more question. I read that you've said that you're a one-term Treasury Secretary. So given that, would you have any advice for your successor?
Good question. I got a lot of advice. You know, when I took this job or all my other jobs, I always came into the job hoping I'd open the desk drawer and you'd find that nice letter from my predecessors with all the wisdom of ages. But it was never there. you kind of have to find your own way in these things. But I'll say a simple thing, which is the most important thing, or among the most important things you have to do in these jobs is, one is you have to be willing to try to put politics aside and try to focus on what's going to help make the economy work, even if the politics of it are terrible. And if you look at the stuff we did in the financial rescue earlier, you can see, and you can look at other countries, how they mismanage it, you can see the value of that basic lesson. And the other thing is it's very important you're willing to well, I think I'll stop there, actually.
To be continued. Maybe there's a book in this. Mr. Secretary, thank you very much.
Thanks
Don
all for
will wrap
coming.
it up.
Again, certainly, Mr. Secretary, thank you very much. It certainly was a unique and tremendous insight of the economy, both nationwide and also worldwide, something that I think that our members don't usually get to hear from a true insider. We certainly appreciate that very much. And Jeff, thank you very much for everything that you did and the presentation you made. Please join me in thanking Jeff Salkin for his presentation. And thanks to GBC staff, and thanks for all of you for attending. Have a great day, and hope you enjoy yourself. Thank you.